So IAS 36, that is impairment loss, talks about, and the idea behind this is that to make sure that none of the assets are overstated in books of account, in financial statement. If any of the asset is overstated, then we make sure that we reduce that asset. So in order to make sure that none of the assets are overstated, we have to review for impairment, and if there is any overstatement of the asset, then we will be recording impairment loss. See, as an accountant, we follow conservative approach, prudence concept, and thereby we make sure that our financials should not be overstated. Maybe in case if there is any expected expenses, we are fine with it. We can record those expenses as provision. But if we talk about any asset or any income or expected gains, then we try not to include them in the books of account unless we are following fair value method or revaluation method. So here also it says that impairment loss is charged in order to make sure that none of the assets are overstated in the books of account. Now, how to make sure? There are some terminologies. We'll understand them. First is carrying amount. What is carrying amount? Carrying amount is equal to book value. Carrying amount is equal to book value. The value at which the asset is stated is recorded in the books of account is known as carrying amount or book value. Example, your property, plant and equipment in balance sheet is recorded at $10,000. Then we will say that 10,000 is the carrying amount or book value. Okay. Give me a quick thumbs up. Are we good till here? Carrying amount and book value are one and the same thing. Amount at which, correct. Good. Amount at which the asset is recorded in financial statements. This is carrying amount. Okay. Next comes fair value. What is fair value? We have earlier also understood as per IFRS 13. As per IFRS 13, it will tell you how to measure fair value. It is the price, exit price received on selling any asset or price or amount paid to settle any liability, in ordinary transaction, between market participants, on measurement date, at measurement date. Okay, this is the definition of fair value. Fair value is calculated as per IFRS 13. IFRS 13 guides you how to measure fair value. Price received on selling an asset or price paid to settle any liability in orderly transaction between market participants at measurement date. So this is your exit price. Under orderly transaction means without any influence, without any biasness. Okay, the buyer and seller are willing. There are regular buyers and sellers. And at the date on which the fair value is calculated, we are taking that value for reference. Okay. Now, next comes cost to sell. Next, third value comes cost to sell. What is cost to sell? What is cost to sell? Any idea?
Initial price of the asset.
Initial price of the asset or the cost necessary to be incurred in order to make sure that the sale is happening. Correct, correct. You can say expense necessary to execute sale, to make sale happen. Example, in order to sell a piece of machinery, a piece of land, it is not possible for you unless you hire a broker. Example, you want to sell a piece of land. You don't know how to locate buyers and all, so you have hired a broker. So any brokerage commission that you're paying on selling the land is known as cost to sell. The necessary expenses that need to be incurred in order to make the sale happen. Got it? Example, brokerage. Correct, correct. Example, brokerage paid. Okay, brokerage expense. Example, it can be even transfer. Example, you want to sell an asset and for this you have listed it on OLX and maybe OLX takes example $10 to get the listing done, just for an example. So the listing done on OLX.com for $10 is necessary and therefore the $10 will be treated as cost to sell. Example, your asset has to be uninstalled, okay, and then only it will be transferred to the customer, to the buyer. So the uninstallation charges, the dismantling charges will be considered as cost to sell. Any expense that is very important, that is unavoidable, that is I would say super necessary in order to make the sale happen is known as cost to sell. It can be brokerage expense, it can be any transportation expense. Okay, any sort of expense. Next terminology comes next, fourth, value in use. What is value in use? Value in use is calculated by present value of future cash flow. Okay. And there is another terminology which is fulfillment value. Fulfillment value also means present value of future cash flow. Value in use, fulfillment value, both means present value of cash flow. The important differentiating factor is this is a term used for asset and this is a term used for liability. Both are calculated exactly in same manner. Okay, but if you talk about value in use, so this is related to asset and fulfillment value is a terminology used in relation to liability. Give me a quick thumbs up. Are we good till here? Good, good. Okay. Quickly, let's understand carrying amount means book value. Fair value means, as per IFRS 13, it's an exit price orderly transaction between market participants at measurement date. Cost to sell is the necessary cost that has to be incurred in order to make sure that the sale is executed, the sale happens. Value in use is present value of future cash flow. Fulfillment value is also present value of future cash flow. Now comes sixth terminology. How do you calculate this? We'll understand first. We will say, let's take fair value. Let's take fair value less cost to sell. Let's take fair value less cost to sell. And let's calculate value in use. Let's calculate fair value less cost to sell amount, and let's calculate value in use. Now, whichever is higher, whichever is higher, okay, will be known as referred as recoverable amount. Will be referred as recoverable amount. We'll call it as RA just for reference purpose. We'll call carrying amount as CA just for reference purpose, and we'll call recoverable amount as RA. Do you understand how to calculate recoverable amount? Fair value less cost to sell and value in use, both these amounts will be calculated. Either of them, whichever is higher, will be treated as recoverable amount.